Well, let's keep it going with macros. And US Federal Reserve is becoming increasingly worried that inflation may not fall back to its 2% target. And that could mean higher interest rates for longer. Minutes from the Fed's July 28th and 29th meeting show that several policymakers were ready to raise rates, while many others said that a hike could become necessary if inflation fails to decline. The key question now is, will the Fed keep rates steady or start raising them again? The Fed left its benchmark interest rate unchanged at 3.5% to 3.75% at the July meeting. But the decision was far from unanimous. Three policymakers dissented, arguing for a quarter percentage point or 25 basis points rate hike. And the minutes show a larger group, described as many, believed tighter policy would likely be needed if inflation stays above the Fed's 2% target. The concern is that price pressures appear to be broad-based. Fed officials warn that failing to act could force the central bank into a steeper and potentially more costly series of rate hikes later. Now, that's important because higher interest rates mean more expensive borrowing for mortgages, businesses and consumers as the Fed tries to slow demand and bring prices under control. There's also a geopolitical factor. The conflict involving US, Israel and Iran has disrupted oil and gas shipments through the Strait of Hormuz, adding to inflation pressures. But there are also signs that price pressures may be easing. US consumer prices rose just 0.1% in July, where annual CPI inflation slowed to 3.4% from 3.5% in June. Core CPI, excluding food and energy, rose 0.2% in July. The labor market is another complication. US firms unexpectedly shed jobs in July, making the Fed more cautious about weakening employment while fighting inflation. That is why the Fed is expected to keep rates unchanged at its September 15th to 16th meeting, even as markets increasingly expect a possible rate hike later. Rate futures were pricing better than even odds of a hike at the October 27th to 28th meeting and a very high probability of one by December if October does not bring an increase. So far now, the Fed is caught between two risks: inflation that remains too high and a labor market that may be losing momentum. The next major inflation and employment readings will help determine which risks the central bank chooses to prioritize.